Inogen, ticker INGN, they beat bottom line consensus, basically met top line expectations for the second quarter of 2026, and yet the stock just completely fell off a cliff.
Yeah, it was an absolute bloodbath after hours.
Right. So let's run the tape on the headline numbers right out of the gate. Revenue came in at $95.1 million. That is up 3.0% year over year, which, slightly edges out the 95.05 million forecast.
Barely a beat, but a beat.
Exactly. And for earnings per share, they reported an adjusted loss of 14 cents per share. That actually beat the expected 17-cent loss by 3 pennies.
But then we get to the guidance.
Yeah, the guidance is what triggered the avalanche here.
Yeah.
Management/full year 2026 revenue guidance to a range of $355 million to $361 million. That is, it's down from their previous guide of $366 to $373 million.
Which is a massive haircut.
It is. But paradoxically, they raised full year adjusted EBIT, earnings before interest, taxes, depreciation, and amortization to roughly $4.0 million. That's a 48% jump from 2025.
Right, they're guiding for more profit on less revenue.
Yeah, and Q3 revenue is expected to be dead flat year over year, so the market punished that top-line outlook mercilessly. Shares closed the regular session at 6.47, but cratered 9.43% in after hours, trading to hit 5.88.
Look, if you were holding this stock or, just watching the respiratory tech sector in general, this report is a brutal reminder of how markets price the future, not the past.
Yeah, the Q2 beat is basically irrelevant now.
Entirely in the rearview mirror. The street looked at the shrinking revenue runway for the back half of 2026 and just, hit the sell button. They completely ignored the underlying operational efficiencies that actually drove the earnings beat in the first place.
Because the top-line growth algorithm looks severely compromised for the next 2 quarters.
Exactly. You have a company demonstrating improved profitability in the present, but getting heavily discounted because tomorrow looks incredibly shaky.
And the market really doesn't care what you did yesterday if tomorrow looks shaky. So we need to figure out why that guidance got slashed when they just beat Q2. And when you look under the hood at the geographic segments, the divergence is just bizarre.
It really is a tale of two markets right now.
Right, because international sales are doing all the heavy lifting. International revenue hit $41.3 million, which is up nearly 15% year over year.
And that's not a fluke.
No, it's not a one-off spike at all. This marks their 10th consecutive quarter of double-digit growth overseas.
Yeah, and management pointed out that favorable foreign exchange rates helped a bit. It gave them like a positive 240 basis point impact on total revenue.
But that's not the whole story.
No, the core driver is their methodical rollout in key international markets. I mean, they just launched the Rove 6 portable oxygen concentrator, the POC, in Canada.
Which is a huge market.
Right, it taps into roughly 2 million COPD patients up there. And that follows a very similar playbook from their recent launch in Brazil. They are actively, deepening their distributor networks across Latin America and Eastern Europe.
So the international model is proving highly repeatable.
Highly repeatable and robust, yeah.
Okay, let's unpack this. Because if international is booming, the U.S. numbers are staggering in the wrong direction.
They're rough.
Yeah, U.S. sales dropped 2% to $42.3 million. And the domestic rental business, which, historically was their cash cow, plummeted 12% to $11.6 million.
That's the metric that really spooked people.
Right. It's like having a star athlete carrying the whole team on the road while the players just totally drop the ball on their home field. I mean, it's like watching a software company that used to sell high-margin monthly subscriptions directly to users suddenly being forced to sell boxed software through a big box retailer at a massive wholesale discount. Why is the domestic side eroding so fast?
Well, it's because the entire U.S. oxygen market is undergoing this massive structural reorganization, and it is moving much faster than Inogen originally modeled.
Moving away from direct-to-consumer.
Exactly. Historically, Inogen dominated the direct-to-consumer or DTC space. Think about the old patient journey, right? A patient gets prescribed heavy, cumbersome oxygen tanks by their doctor.
Nobody wants to lug those around.
Right. They hate the lack of mobility.
Yeah.
So they see an Inogen advertisement on television, and they call the company directly to rent a lightweight portable unit out of pocket.
Which created a beautiful, high-margin, recurring rental revenue stream for Inogen. They own the customer completely.
Just bypass the middleman model.
Yeah.
But that middleman is striking back now.
How so?
The middleman has completely changed the point of entry. Home medical equipment providers, the local HME shops that fulfill Medicare prescriptions, they're no longer waiting for patients to complain about heavy tanks.
So what are they doing instead?
The HMEs are stepping in and prescribing portable oxygen concentrators from day one.
Wait, so the patient walks out of the clinic and the HME just hands them a portable unit immediately, covered by their standard insurance.
Yes, exactly. And that single change in behavior completely neutralizes Inogen's direct-to-consumer funnel.
Because why would I pay out of pocket if I just got one for free through my insurance?
Right. If a patient gets a portable unit through their HME provider on their first day of therapy, they never have a reason to call Inogen to rent one.
Even if the device the HME gives them is actually an Inogen unit.
Yes, the patient is still getting an Inogen device, but Inogen is now selling bulk units wholesale to the HME instead of renting them at a premium directly to the end user.
Which perfectly explains the 12% drop in U.S. rentals. The volume of patients needing oxygen isn't shrinking, but the distribution channel has fundamentally shifted from retail to wholesale.
Yeah, and this B2B shift, I mean, it drives unit volume up, but it crushes the per unit margin.
Because you lose the rental fee.
You lose the recurring monthly rental fee, you lose the direct patient relationship, and you trade it for, lower margin, bulk wholesale orders. It is a very painful transition for any business to endure.
So if their high-margin U.S. direct business is crashing in favor of wholesale volume, you would expect their profit margins to be in free fall, right?
That's a logical assumption, yeah.
But here's where it gets really interesting. That didn't happen. Defying basic financial gravity, total gross margin actually expanded to 45.5%, which is up from 44.8% a year ago.
That's pretty wild.
Yeah, adjusted gross margin hit 45.6%. How does a company shift to a structurally lower margin sales channel, yet overall gross margins actually went up?
It is the most counterintuitive metric in the entire filing. And honestly, it's a massive operational victory for the management team.
How did they pull it off?
Well, when your product mix degrades toward wholesale, you do expect severe margin compression. So management combated this by tearing the P&L down to the studs. They implemented really intense cost-saving initiatives across the board.
Okay, but you can only cut so much overhead.
True. But the single biggest lever they pulled, and this is a crucial detail for anyone modeling the stock, was a drastic reduction in warranty expenses.
Wait, meaning the oxygen concentrators simply aren't breaking down as often in the field?
Exactly. Product quality improved significantly. And when you sell medical devices that literally keep people breathing, durability is paramount.
Because those portable units take a serious beating.
Oh yeah, they travel, they get dropped, their compressors run constantly, and every time a unit breaks down, the manufacturer eats the cost of shipping, repairing, and replacing that device.
So by engineering a better product, they just stop bleeding money on the back end?
Right. They slash those back-end warranty claims.
Hmm.
And the savings from those unspent repair costs dropped directly to the gross margin line, which completely offset the negative pressure from the B2B wholesale shift.
That's impressive.
It proves their manufacturing and quality control are highly dialed in right now.
And that kind of operational discipline, it shows up on the balance sheet too. I mean, if you are staring at that 9.5% after-hours stock drop, you really need to look at what they are actually holding in the bank.
The balance sheet is a fortress.
It's absolutely pristine. They ended Q2 with $106.8 million in cash equivalents, and marketable securities.
With zero debt.
Zero debt, positive operating cash flow of $2.9 million, and free cash flow of $1 million for the quarter.
Having over $100 million in unencumbered cash while navigating a brutal business model transition that is a luxury most microcap companies just do not have.
It's a massive safety net.
Yeah, it means they have the flexibility to invest in their sales force, fund clinical trials, execute new product launches, and they can do all of that without needing to tap the debt markets at current interest rates.
Or dilute you by issuing new shares at these depressed valuations. In fact, management clearly believes the equity is mispriced because they are actively shrinking the float. They repurchased 1.14 million shares of their common stock for $7.5 million in the first half of the year.
Which is a huge signal.
Let's put that in perspective for a second. The total market cap is hovering around $177 million, and they have $106 million of that sitting in pure cash. Buying back stock at these levels sends a very strong signal that management thinks the market is pricing them for bankruptcy, while they are literally sitting on a fortress balance sheet.
And they still have about $22.5 million remaining on their $30 million share repurchase authorization.
So they have plenty of dry powder to keep buying if the stock stays depressed.
Tons of dry powder. When you back out that cash position, The enterprise value, the market's valuation of the actual operating business is roughly $70 million.
That's incredibly low.
It is. For a company generating $355 million in revenue with 45% gross margins, the market is exclusively pricing in the fear of the U.S. direct-to-consumer business collapsing.
And assigning almost zero value to the cash, the international growth, or the pipeline.
Right.
Well, speaking of the pipeline, that cash fortress is essentially buying management the time they need to execute a total strategic overhaul.
Yeah, the platform strategy.
Right. CEO Kevin Smith was very vocal on the call about moving Inogen away from being just a single product, travel oxygen company. They are attempting to transform into a diversified respiratory care platform.
They want to own the bedside table, not just the travel bag.
Exactly. But transitioning from a single product company to a comprehensive platform is incredibly difficult.
It is, but honestly, it is the only way to survive the B2B shift we just discussed.
Why is that?
Because if you're going to rely on home medical equipment providers for distribution, you need to offer them a full suite of products. The HME doesn't want to buy portable oxygen from Inogen and then stationary home oxygen from a competitor and CPAP masks from a third vendor.
They want one supplier.
Right, they want a single, reliable supplier to simplify their own supply chain.
Okay, let's look at the actual products rolling out to fulfill that platform strategy. First, you have Boxy, their new stationary oxygen concentrator. It's targeting a $300 million total addressable market, or TAM, and they've shipped over 5,000 units so far.
Which makes sense because almost every patient who uses a portable unit also has a stationary unit at home.
So it allows Inogen to capture both sides of the oxygen therapy equation.
Yep.
And then you have Aurora, their entry into the CPAP mask market, which addresses a massive $2.2 billion TAM.
Aurora is a really fascinating play. Securing a foothold in the CPAP mask market is notoriously difficult.
Because patients don't like switching masks.
Exactly. Patients who suffer from sleep apnea are highly resistant to changing masks once they find one that works. Adherence to therapy is the biggest hurdle in sleep medicine.
But they're making headway, right?
They are. Management noted that customer accounts for Aurora actually doubled sequentially in the quarter.
Oh, wow. Doubled.
Yeah. Furthermore, they presented data at a major sleep conference showing that experienced CPAP users, meaning people who are already satisfied with their current masks, overwhelmingly preferred Aurora after a 90-day in-home study.
Clearing that hurdle with experienced users is a very strong indicator of product market fit.
Huge indicator, yeah.
And beyond oxygen and sleep, they are pushing into airway clearance with a product called Simiox. They estimate a $500 million US TAM just in treating non-cystic fibrosis bronchiectasis.
It's a very specific but lucrative niche.
Yeah. They just completed enrollment for their SCOPE study in China, and their IMPACT T200 trial is progressing to secure U.S. CMS reimbursement.
Which is key.
And to manage all of this operational scale-up, they brought in a new Chief Operating Officer, Andy Redding, who has over 30 years of med tech experience.
Bringing in a seasoned executive like Redding is a clear indicator that Inogen is moving out of the R&D phase and into heavy commercialization.
What does he bring to the table specifically?
He has a specific track record of managing global sales force expansions and navigating CMS, the Centers for Medicare and Medicaid Services.
Getting those codes.
Right. Securing those CMS reimbursement codes is the absolute lifeblood of medtech. If Medicare won't pay for it, the HMEs simply won't stock it. Reading's job is to make sure products like Simiox clear those regulatory and reimbursement hurdles.
Okay, I am going to throw a flag on the play here, though.
Go for it.
I hear management throwing around multi-billion-dollar TAMs for CPAP masks and a $500 million TAM for airway clearance. Yet on the earnings call, they admitted that these new products, specifically Boxy and Aurora, only contributed a little over 100 basis points of growth this quarter.
Yeah, the actual revenue contribution is tiny right now.
So as an investor, you have to ask, is this a legitimate, viable turnaround strategy? Or just a highly speculative pipeline being touted to distract us from the fact that their core U.S. rental business is bleeding out?
Look, the skepticism is fully warranted. When a management team points to billions in theoretical market size while delivering literal pennies in actual revenue contribution, investors naturally hit the sell button.
Which explains a lot of that after-hours drop.
Yes. However, if you understand how B2B medical distribution actually works, you know that revenue does not scale linearly at first. Getting your product onto the shelf of an HME provider is the ultimate bottleneck.
Because it requires months of negotiation, right?
Months of negotiation, Pilot testing, contract wrangling, all of that before a distributor actually commits.
But the Aurora accounts doubled.
Exactly. The fact that Aurora accounts doubled sequentially is the proof of concept. It means Inogen is successfully leveraging the relationships they built, selling portable oxygen to cross-sell CPAP masks into those exact same B2B distribution pipes.
Okay, so the pipes are working.
The dollar amount is small today, but they are validating the commercial infrastructure needed to scale. Once the product is in the channel and the sales reps are trained on it, volume can ramp up non-linearly.
But whether those new distribution pipes can pump enough volume fast enough to save the top line brings us right back to the elephant in the room.
The lowered revenue guidance.
The lowered revenue guidance and the heightened execution risk for the rest of 2026. So what does this all mean? Let's dissect this guidance cut. They lowered the full-year revenue range to $355 to $361 million.
Which implies only about 3% growth at the midpoint.
Right, and for Q3, they expect revenue to be completely flat year over year. Management didn't just blame the U.S. channel mix shift this time either.
No, they didn't.
They specifically cited international distributor inventory timing and delayed tenders, creating a choppy second half. What is the actual mechanism causing that international drag?
Think of it like a wholesale buyer who overordered for the holidays. International distributors purchased massive quantities of Inogen units over the past few quarters just to ensure they had enough stock on hand to meet patient demands.
Okay.
But now, their warehouses are full. They're going to sell through the inventory they already bought before they call Inogen to place another bulk order.
Got it. It basically creates a temporary air pocket in Inogen's revenue stream.
Exactly. Combine that inventory digestion with delayed international tenders, which are essentially these massive, slow-moving government or institutional health contracts, and you end up with a very flat, uninspiring Q3 forecast.
So the underlying patient demand isn't necessarily dropping, but the timing of the cash flows gets severely disrupted.
Right. Management views it as a transitory issue, but as we saw in the after-hours trading, the market absolutely hates uncertainty.
The market hates uncertainty, and they are walking an incredibly thin tightrope here. I mean, look at the profit guidance. They raised their full-year adjusted EBITDA goal to roughly $4.0 million. But if you look back at Q1, they posted an adjusted EBITDA loss of $1.4 million.
And they pulled off a $2.4 million gain in Q2.
Right. So to hit $4.0 million for the full year, the back half of the year has to carry a massive load. And they have to do it while navigating a completely flat top line in Q3.
It leaves almost zero margin for error.
None at all.
To hit that $4 million EBITDA target, they have to flawlessly control their SG&A, their selling, general, and administrative expenses.
While simultaneously expanding.
Exactly. They have to balance aggressive B2B expansion, fund the rollout of Aurora and Boxy, expand their sales force, and do all of it without letting their operating expenses bloat.
And they have to do it while facing potential supply chain costs and inflationary pressures. I mean, the CFO explicitly acknowledged on the call that those pressures are still lingering in the background.
Yep. If there is a supply chain hiccup, or if those warranty expenses we talked about earlier suddenly creep back up, that profit guidance shatters.
It's a house of cards.
They are heavily banking on their internal cost-saving measures and sustained product quality to defend that 44 to 45% gross margin profile. If international orders stall longer than expected, or if it costs slightly more to manufacture the units, they simply won't be able to outrun the expense load.
It creates a fascinating standoff for anyone watching this stock. You have a company in deep transition, trading near 52-week lows, with a market cap hovering around $177 million. Yet they're clutching over $106 million in pure cash with zero debt.
It's a huge paradox.
It is. So if the traditional U.S. direct-to-consumer oxygen rental market is permanently migrating to upfront wholesale prescriptions, you have to ask yourself, is Inogen's legacy business just a melting ice cube?
That's the bear thesis.
Or is their massive cash pile and aggressive pivot toward owning the bedside table exactly the bridge they need to dominate the next era of respiratory tech?
The balance sheet guarantees they have the time and capital to build that bridge. The real risk is whether the broader market has the patience to let them cross it before pricing them out completely.
We will definitely be tracking that Q3 flatline closely to see if volume actually picks back up. If you are navigating these choppy markets and trying to make sense of these reports, make sure you follow the deep dive for your daily dose of no-nonsense earnings coverage. We run the numbers, track the margins, and find the real story so you don't have to.